Of course, ELSS are the most popular choice for saving taxes even now. It should be seen more as a wealth creation tool rather than a tax saving option. See, if you select funds based only on their past 3 years or 5-year returns, that might not be the best approach. Do you know why? Because equity funds go through cycles and different investment styles perform well at different times. Check how the fund has performed during both bullish and bearish market phases. That's a very important point to check. Look for an AMC with a strong financial position and consistent performance. Evaluate the experience and past performance of the fund manager. These are not just theoretical concepts. Most of this information is easily available. Be cautious of extremely large funds as they might face challenges in deploying capital efficiently. Of course, no fund can be at the top all the time. Please don't compare apples with oranges. Higher expense ratios means a bigger chunk of your returns is eaten away by operational costs. Opt for growth plans and not dividend plans. Opt for direct plans and not the regular plans. Here's a guide on how to choose the best ELSS mutual funds. I started my ELSS investment 8 years back, and that was the first tax saving tool which I opted for. Of course, ELSS are the most popular choice for saving taxes even now. In today's video, I'm quickly going to cover 8 important tips for selecting an ELSS mutual fund. You can apply these tips to other non-ELSS mutual funds as well. And towards the end of the video, I'll recommend 2-3 ELSS mutual funds based on my analysis, where I have invested my money as well as my friends and family's money. Hello people, I am Suraj Deo and welcome back to Deotalks. Okay, so equity linked savings scheme or ELSS is a pure play equity product, which means it should be seen more as a wealth creation tool rather than a tax saving option. ELSS funds offer a unique advantage. There you can enjoy tax benefits while also having the potential for long-term growth through capital appreciation, wherein the value of your investment increases over time. In general, if you are willing to take on a bit of risk, ELSS can be an excellent option. See, if you select funds based only on their past 3 years or 5-year returns, that might not be the best approach for your long-term investment journey. Do you know why? Because equity funds go through cycles and different investment styles perform well at different times. So how to select the best ELSS funds? Okay, let's start. Number 1. Performance across market cycles and long-term performance. Look at how the mutual fund has performed over long periods, such as 8 years or 10 years. Also check how the fund has performed during both bullish and bearish market phases. That's a very important point to check. While past performance may not always indicate that the future of the fund will be the same, but it often helps you in estimating the capability of the fund management under different market conditions. There are a few important ratios which you should consider in the evaluation process. We will cover them towards the end of the video. Number 2. AMC history and fund manager's track record. The asset management company or AMC and the fund manager's reputation and track record are key factors in selecting an ELSS fund. A well-established AMC with a long history of successful fund management indicates stability and expertise. Look for an AMC with a strong financial position and consistent performance across different market cycles. Evaluate the experience and past performance of the fund manager. They should have a proven track record of picking the right stocks and building strong portfolios. If the fund manager continuously performs well for a long time, it may indicate that such a mutual fund scheme may repeat its performance under similar market conditions. Also try to evaluate the performance of other funds they have managed in the past or are currently handling. Choose an AMC committed to transparency, ethical practices, and responsible handling of investor funds. Do check if they have a clean track record of regulatory compliance. Remember, these are not just theoretical concepts. Most of this information is easily available on the internet today. Number 3. Fund size. A moderate-sized fund with substantial AUM often indicates stability and liquidity. But be cautious of extremely large funds as they might face challenges in deploying capital efficiently. Their large size can limit their ability to react quickly to market changes, potentially leading to lower returns. So watch out for potential issues if the fund becomes too large. Smaller funds may offer higher potential return, but may also carry higher volatility. The ideal fund size depends on your risk tolerance and investment goals. If you are risk averse and prioritize stability and liquidity, then opt for moderate size or large funds. If you're seeking alpha or superior returns and comfortable with higher risk, then consider smaller funds with experienced managers. However, if you have specific short-term goals and want better liquidity, then choose large or moderate size funds for easy entry or exit. Therefore, assess the fund size carefully. One small request before we move further. If you have found this information useful so far, please like this video and subscribe to our community. Your support means a lot. Number 4. comparative analysis or benchmarking and peer performance. Every ELSS mutual fund has a benchmark index, typically a broad market index like Nifty 50 or Nifty 100. Comparing the fund's returns to the benchmark allows you to assess its ability to track the market performance. Also compare the fund's performance to its peers, that is similar ELSS, to see if it has beaten them consistently in the past. So look for funds with a consistent track record of outperforming their peers, especially during market downturns. Consistent outperformance relative to its benchmark and peers indicates skilled fund management and effective investment strategies. Of course, no fund can be at the top all the time, but generally good funds tend to appear in the top category for extended periods. Also remember that comparison should be done with right peers and the right benchmark. Please don't compare apples with oranges. Number 5. Concentration risk. Concentration risk arises when a mutual fund invests a significant portion of its assets in a limited number of stocks, sectors, or other asset classes. This exposes the fund and consequently its investors to increased risk if those specific investments underperform. Check if the mutual fund is heavily concentrated in certain stocks or sectors. An ELSS fund with a higher concentration in large cap stocks usually offers more stability in terms of return and risk ratio. On the other hand, ELSS having a greater concentration in mid or small cap stocks are comparatively volatile. They carry higher risk, but at the same time, they can have the potential to generate higher returns. Number 6. Expense ratios. Simply put, expense ratios represent the yearly cost of operating a mutual fund, including management fees, marketing expenses, administrative costs, and other related expenses. These costs are expressed as a percentage of the fund's average net assets. Every year, the expense ratio is deducted from the fund's returns, directly impacting your overall profits from mutual fund investments. Higher expense ratios means a bigger chunk of your returns is eaten away by operational costs, leaving you with less money in your pocket. The average expense ratio for actively managed mutual funds ranges between 0.5% and 1%. While lower ratios are generally preferable, it's crucial to consider the fund's overall performance and management strategy. However, a slightly higher expense ratio might be justifiable if the fund consistently delivers superior returns. Number 7. Opt for growth plans and not dividend plans. Let's understand the dividend plans first. Dividends are profits distributed to investors from the mutual fund's earnings. When you choose the dividend plan, the fund pays out a portion of its profits, reducing the net asset value or NAV per unit. So actually you receive regular payouts but at the cost of NAV reduction. It's important to note that the market regulator SEBI has changed the names of these plans to IDCW as their payouts are not really dividends. What you get here is a part of your capital and a part of your returns back. Hence the name IDCW, that is income distribution and capital withdrawal. Dividend plans or IDCW are beneficial for investors seeking regular income, but they may not be tax efficient and might impact wealth accumulation due to reduced NAV. IDCW payouts are also taxed as per your applicable tax slab. So if you fall in the highest slab, say 30%, then approx 1/3 of the payout will go away in taxes. Growth plans. With the growth option, the profits earned by the fund are reinvested, leading to their NAV growth. There are no regular payouts. Instead, your investment compounds over time, potentially resulting in higher overall returns. Growth plans are ideal for investors focused on long-term wealth creation, as compounding benefits can significantly boost the investment's value over time. So in simple terms, the dividend that a fund offers gets deducted from the NAV. If you are investing in an ELS for the long term, do not go for the dividend plan. Dividends are good only if you want regular income. But if your goal is wealth creation, you should always opt for the growth plans. Number 8. Opt for direct plans and not the regular plans. Direct plans allow investors to invest in mutual funds directly with the fund house without going through an intermediary such as a broker or distributor. This means that investors can save on the commission that would be paid to the intermediary. As a result, direct plans have a lower expense ratio than regular plans. Regular plans are the traditional way to invest in mutual funds, and they are sold through intermediaries such as brokers or distributors. These intermediaries charge a commission for their services, which is reflected in the higher expense ratio of regular plans. Now, there are a few important ratios like Sharpe ratio, standard deviation, and Jensen alpha, etc., using which you can evaluate the mutual funds. We will cover them in the second part of this video, just to keep this video short and simple. Just to summarize, choose mutual funds with high Sharpe ratio, lower standard deviation, high alpha, and consistent and better performance compared to its peers. So by considering all these factors, you can make a more comprehensive evaluation of a fund's potential for long-term success beyond just past returns. In the pinned comments, I have listed some of the best ELSS funds based on my analysis, using the criteria we discussed earlier in this video. That's all for now. Please feel free to leave any question or comments below. Thanks a lot for your time and let's take care of this beautiful world. I'll see you next and smile. Always smile.